Welcome to the Accountancy Learning AAT sample paper walkthroughs. In this video, I'll take you through the Financial Accounting Level 3 Sample Paper 1 Task 2. So let's get started. Alice owns a business which provides cakes for corporate clients. You are preparing the accounts for the year ending the 31st of March 20x8. The business is registered for VAT. We need to identify which of the following should be included in the valuation of inventory under IAS 2 inventory rules. So we're looking at what should be included. Now, the valuation of inventory includes all costs that go into making that final end product. So when you look at the options that we're given delivery costs for the ingredients to be delivered to the business, then delivery costs for the cakes to go to customers, and refrigeration costs for the cakes. Now, the bottom two here are about cakes, and that is what our final product is. So we won't include them in the valuation of inventory, but we do need the ingredients to make the cakes, and therefore we would include the delivery costs to get those ingredients to the business. An adjustment for accrued expenses for rent has not been completed. Identify the effect of this error on each of the following items. So we're looking at the accrual for rent has not gone through. So assets, there'll be no effect on the assets because the accrued expenses account is a liability account. And profit is going to be overstated because the cost of that rent hasn't yet been put through. So once that has been put through, our profit will reduce. So therefore, it's been overstated. Paul has recently started to use accounting software to process his financial transactions. An advantage of using accounting software when dealing with inventory is that the value of inventory will always be accurate, or the inventory can be tracked and valued more easily. Now, even using accounting software, the value of inventory won't always be accurate, but it does mean that we can track and value it more easily. So now to part B. You are now working on the rental income for a business for the year ending 31st March X8. In the previous financial year, an adjustment for prepaid rental income of £1,000 was made. The reversal for this year has yet to be made in the current year account. Cash book entries for the current year relating to rental income are £12,000, including a receipt of £3,800 which related to the following financial year. We're asked to complete the prepaid income account for the year ending the 31st March 20x8. We've got to balance it off appropriately and work to the nearest whole pound. Now be very careful here and make sure you really understand what account it is you're working in, as we're working in the prepaid income account, not the rental income account. So let's have a look at what we were told. So last year there was an adjustment for prepaid rental income. So what would have happened is we would have debited the income because it didn't belong to that year, and we would have credited the prepaid income account. So we now need to do the opposite. So we need to debit the prepaid income account, and we would credit the rental income account because it's now in the right year of 1,000. Now the cash book entries for 12,000 don't apply to the prepaid income account. They would go into your rental income account. But what we do need to deal with is this 3,800 that relates to the following financial year. So we need to prepay that. So what would happen is we would debit our rental income account and we will credit our prepaid income. Now remember, we need to balance it off appropriately. It's our year end it's our liability account, so we just need to balance it off with a balance carried down. So these will have totaled in your exam. So we need that to be 4,800 on each side. So our balance carried down is on our debit side of 3,800. You're working on the accounts of William, who runs a business as a sole trader. The balance on the receivables ledger control account as at the 31st of March X8 is 27,468. Based on experience, the business has a policy to adjust the allowance for doubtful receivables to 2% of the total receivables after deducting specific doubtful receivables. The business only has one general ledger account which contains specific and general allowances for doubtful receivables. The allowance for doubtful receivables at the 1st of April was 558.27. The business has asked you make an allowance for a specific doubtful receivable of 2,380 as they believe a credit customer is about to cease trading. We need to produce the journals relating to the allowance for doubtful receivables and journal the specific and generals separately and work to 2 decimal places. So let's deal first of all with our specific one. So we are going to have an allowance for doubtful receivables account, and we'll also have an allowance for doubtful receivables adjustment account. So the adjustment account is going to be where we record the increase and decrease in the expense to the business. So this specific doubtful receivable is going to be a full expense to the business. So that will be our debit. And the allowance for doubtful receivables is our liability account, it's our provision account. So that will be our credit. Now we need to look at what is our 2% for the general going to be. So we can put in that we've got the same accounts that we're going to work with. So we've got our provision account and our adjustment account there. Now at the start of the year, we had £558.27 as the doubtful receivables balance. We now need 2% of the new receivables balance. So we've got to take off the specific debt first. So we're going to take the 2,380 off to give us a new balance of £25,088. Then we're going to take 2% of that 25,088. So the actual balance of the allowance for doubtful receivables should be 105.01, but it's currently at 558.27. So we need to reduce it. The difference between the two is 56.51. So we need to reduce our allowance by 56.51. So the allowance for doubtful receivables is where that 558.27 is sitting at the moment. That's our credit balance. So we need to debit that to reduce that down. And we credit the adjustment account, which is effectively reducing the expense to the business. And that completes task 2.